Happy Monday. I hope you had a great weekend. Today is April 4th, 2022. Happy wedding anniversary to my wonderful bride, and this is your Monday market update. The news that's moving the markets keeps shifting, so as much as I'll keep doing these Monday update videos, please remember that we are long-term investors, and we need to keep the long-term goals in mind. That being said, the first quarter is in the books, and we're about to enter the best month of the year historically. According to LPL Research, April is the best month of the year on average since 1950. It's also been higher 15 of the past 16 years. It's the best month of the year in the past 20 years as well, and it's the second best month in the past decade. The slight flaw is that in a midterm year, it is only ranked 7th, and it is barely positive. Okay, all of that, and with that, what we've talked about for the past 2 years, can we really rely on historic norms, or is it different this time? I'm pretty sure you know where I feel about this. So just a quick note that this week is the two-year anniversary of doing these videos. I hope you get something from them. If you have something that you'd like me to cover, either on the market update side or the Friday planning video side, please let me know. Also, I am considering bringing back the coffee chats. You may recall these are the 15-minute Zoom presentations on a topic of interest. We've done college planning, we've done Medicare, we've even done planned giving. Those are all on my YouTube page. I am considering a coffee chat about Social Security, but I wanted to see if anyone has any interest. If you have interest in this, please let me know, email me, or call me. Let's get into the recap of last week's action and talk for a moment about what we'll be looking for this week. Monday last week, stocks opened a bit flat after a quiet weekend of news. Traders were looking ahead to big economic news and news from the Russian-Ukrainian conflict. Oil prices dropped and the 10s-2 spread fell into the single digits. Stocks were slightly negative but moved into positive territory as oil closed down 7% on the day with the new lockdown news in China. As we've seen, oil down, stocks up. Then we got news on the wires that Russia would be okay if Ukraine joined the EU, with conditions, of course. But that was viewed as progress, and the stocks climbed into the final hour. The S&P 500 was just up under 0.75% for the day. The Dow was up slightly. NASDAQ up 1.3%. The 10-year Treasury at 2.5%. Oil at 103.50. Tesla also announced its intent to split the stock again. AMC was up huge, doubling down on the plan to go outside of the movie business with the capital that they've raised in the markets. Recall, they just bought a gold and silver mine. I think that this is not getting enough criticism. Call me if you want some more detail on this. As much as they tried, Will Smith and Chris Rock could not steal all the thunder, though there were reports that a boxing promoter was offering them $30 million to fight it out in the ring. All right, Tuesday, stocks gapped higher on positive commentary on the war front. Constructive was the word of the day. The chief Russian negotiator also used the words I spoke to you about a few weeks ago, de-escalation. Based on what's happening there, I'm not sure that word means what you think it means. To no surprise, the market pulled back as the Russians walked back all that information, walked that back a little bit. Fed member Harker, who's a voting member, he was less committed on a 50 basis point hike at the May meeting. Remember, this is what the market is already expecting. So good geopolitical news was enough to have the S&P 500 up 1.25%. Dow was up about 1%, NASDAQ and up nearly 2% on the day. The S&P 500 has rallied 10% from the 2022 lows on the combination of oversold conditions being resolved, especially in tech, the Russia-Ukraine war not getting worse and hopes of a ceasefire, the Fed meeting that was also not worse than expected, and positive corporate commentary. This is what's gotten us back to here, but I do think we'll need more than not getting worse and hopeful commentary to get us to move significantly higher. Stocks were trading a bit heavy on the open on Wednesday. As we heard from the Kremlin, nothing to see here. Well, actually, it was that there was nothing particularly promising or that would constitute a breakthrough in talks. So we also saw some weak economic data from Europe, inline ADP jobs report, and the S&P 500 was down about 0.5%. The yield curve did invert, and we've been speaking about that. The 10s-2s went negative for a bit. There's a lot of it's different this time talk, so we'll have to see. If you hold to history, the clock has now started. Recession is coming. We'll get to more details on that in coming weeks. We actually do have time before we have to see that happen. As we move into Thursday, the last trading day of Q1 and of March, I think most of us were ready to say goodbye to that quarter. For the quarter, the S&P 500 was down 4.78%, the Dow was down 3.71%, the NASDAQ down 8.81%. As Q2 got started, stocks opened a little bit lower for a second day in a row, still focused on the war, digesting the expected but still ugly inflation numbers. Core PCE, the Fed's favorite measure, was in line, but still up nearly 5.5% year over year, the highest level since 1983, the Reagan administration, and showing signs that we have not yet peaked. Remember, that's the other headline I mentioned we're waiting for, peak inflation. It's not here yet. There's more disappointing economic news from overseas, China and Europe, and the opposite of what we wanted to hear from the war, escalation. Stocks did recover somewhat when President Biden announced that he will release 180 million barrels of oil from the Strategic Petroleum Reserve in the next 180 days. This was piled on by our allies as they also committed to releasing more oil into the market. We'll talk about this in the coming weeks, but it's been noted time and time again since the announcement that this is a very short-term fix. All of that oil will have to be replaced. The government is trying to time the oil market, and you know how I feel about timing the market. That was not enough to keep the stocks from rolling over and selling off into the end of the day. The S&P 500 was down over 1.5% on the day. Dow and NASDAQ down about the same. Stocks advanced on Friday as we opened the second quarter. Both the Dow and the S&P struggled throughout the day, but rose slightly into the close, as did the NASDAQ. The jobs report was a bit below consensus, but not enough to really make a difference in the outcome. On the Fed side, as I've mentioned to you, there's a lot of stale news that rocks this boat from side to side. The Fed and war both are major near-term drivers, but nothing new from either of them. As always, the week following jobs numbers this coming week will be a bit quieter than usual. We'll have the Fed minutes from the March meeting, but that should not be too much of a surprise. The Fed action is pretty well baked into the cake by now. We will be watching to see just how hawkish the Fed is and really looking to get some more information on the upcoming balance sheet reduction. That could be a key catalyst. Aside from that, we'll watch for the ISM service PMI due out tomorrow. Manufacturing PMI that was out last week was just weak enough to restart the stagflation talk, and we'll be looking to see if there's more evidence of that. I want to wrap up with a small redirection. I've told you to watch for two main headlines: ceasefire or even de-escalation will do, and peak inflation. The second one will be hard to come by this month, as the inflation reports will be the first real reports that are coming out with the war numbers in them. The ceasefire headline, when it comes, I just want to remind you that it will be a great short-term catalyst for the market, more likely than not. But I do want to add a small bit of color to this. This conflict has gone on too long, and the surge in commodity prices cannot be reversed that quickly. On February 1st, oil was at $84 a barrel, now at about $100. Corn, $6.25, now at $7.44. Wheat, $7.80, now at $10.40. Nat gas, $4, now at $5.25. As I've told you, the war premium will come off when they stop fighting, but it'll take more than that to get those numbers back down. Remember, sanctions. They will remain in place for months, if not years. Russia was the 12th largest economy in the world, and they've been pretty much closed for business to most of the world. War or lack thereof will not impact so much the main issue, Fed policy. Remember, the Fed is reversing the policy that has supported this market for the last number of years. We will keep looking for the strength and the source of the next move higher, but this will most likely not be the long-term catalyst we need. Insert earnings here. That's what we need to watch for. Keep in touch. I'm watching all of this closely for you, and we'll keep you informed. Even with stagflation talk and even with yield curve inversion, we don't think it's time to run for the hills. As we started this, keep your eye on the long-term plan. Have a great week.